सीमाओं से सरहदों तक, पहले इंडियन, फिर ऑयल, इंडियन ऑयल।
For over 140 years, we have partnered India's growth story. A journey from a nation of hardworking farmers and traders to being the global benchmark in industrial development. BSC, experience the new.
मधुर शुगर की 5S गारंटी के साथ चखिए स्वाद मिठास का।
Good morning and welcome to the day one of the Hindu BusinessLine Commodity Market Outlook 2022. This event is powered by Indian Oil in association with Madhur Pure and Hygiene Sugars, and associate sponsors are BSC. Our knowledge partner is NCDEX. I am your host, M.R. Subramani, Commodities Editor for the BusinessLine, and I'll be your moderator for today. Let me give you a broad outlook of the commodity sector. 2020 was a year of pandemic. No one would have believed that 2021 would be a year of strong performance for commodities when we had we said at the end of the year then. But things have all changed. For example, the S&P GSCI index, you can notice in that it's gained over 34% year to date. Pitch Solution Aggregate Commodity Price Index has increased by 43%, LME Index by 26%, and Bloomberg Commodity Index by over 25%. In fact, commodities have been one of the best performing asset class. The shutdown due because of coronavirus had affected production, and agriculture was one of the main victims. There were supply woes due to the same problem. There was the La Nina weather effect playing or wreaking havoc on production of agricultural crops, mainly oil seeds, coffee, wheat, sugarcane, and logistics also saw a lot of confusion, and prices of shipping skyrocketed this year. So all these things have happened. Now, how will 2022 be for commodities? There are some dark clouds looming over the emergence of Omicron variant of the coronavirus. It's a matter of concern because nobody has been able to exactly say what are the risks that we are going to face because of the Omicron variant. There is no clear threat to be on the Omicron variant, if you have to be frank. Two, La Nina has set in already this year, and it could extend its tenure till May. This could lead to a rise to rains and floods in some parts of the world and dry weather in other parts of the world, especially the Americas. We'll have to see how the weather event will pan out. Then there are also geopolitical risks, which we'll deal with later. On the macroeconomy front, there are factors that could tap the upside for commodities, and central banks are likely to tighten their monetary policies. The US dollar could gain, and these are the ones which we'll have to watch out for in 2022. Some analysts view that next year probably may not see commodities continuing their phenomenal run like this year. The jury is still out, as we also will try to figure out what is likely to happen over the next two days during our commodities outlook session. We will discuss the outlook for various commodities through 4 sessions: one on energy, one on agriculture, both of which will be gone through today. Tomorrow, we will discuss the prospect for precious metals and base metals. Now, we will have the two-day event flagged off by Mr. V.S. Sundaresan, Executive Director, SEBI. He will make his keynote address. With over 30 years of experience in the securities market, Mr. Sundaresan is currently heading the Integrated Surveillance Department and Commodities Derivatives Market Regulation Department. In the past, his assignments include formulation and enforcement of regulations on issuance of securities, takeovers, buyback, delisting, trading, clearing, and settlement, risk management, dematerialization, registration, and supervision of intermediaries. Mr. Sundaresan, a member of various SEBI and interregulatory committees, has a degree in law and is a certified associate member of the Indian Institute of Banking and Finance. I now request Mr. Sundaresan to kick off this event with his keynote address. Welcome.
Good morning to all the dignitaries and participants. Am I audible?
Yeah, you're audible.
Thank you. Good morning once again. It is very heartening to know that this virtual event has been organized by BusinessLine, which belongs to one of the highly respected print media group in the country. I consider it as a great privilege to be part of this event and address the participants. As rightly pointed out in the inaugural speech, we are aware that the world has been witnessing a crisis situation due to COVID-19 pandemic, adversely impacting the economies world over. COVID-19 instilled fears in the minds of people, something which we have never endured before, impacting human behavior. We all are scared of traveling, we all are scared of meeting people, and this type of fears have never been felt by all of us in the past. These are large repercussions, not only for the economy, but for all the human behavior as well, and which has resulted in an unprecedented contraction in every sector. The performance of the economic activity during the past 2 years has been largely driven by the phase of recovery, more for survival rather than for development. In my opinion, the evolution of this COVID-19 trajectory is likely to have a major bearing on the future economic activity as well. During the crisis period, the Indian securities market has shown commendable resilience and sustained the onslaught of the pandemic. However, the real economy has suffered and caused agony and disgust to all segments of the society. Despite that, as pointed out earlier, the commodity derivatives sector has been reasonably successful in maintaining a steady growth path. Not only it showed its resilience against the disruptions caused by the COVID-19, it rather expanded its scope in terms of trading volumes. Let me talk about the event today. The theme of the event is centered on the commodity sectors and its outlook for the year 2022. I therefore propose to take all of you through my speech, the history of the commodity derivatives market, the recent developments, and what the future beholds for the commodity sectors, which comprises of agriculture, energy, bullion, and base metals, of course, taking into account the impact of pandemic. Let me first briefly tell about the role of commodity derivatives market. Commodity derivatives market have huge economic significance in the lives of people and economic well-being of nations. Well-functioning commodity derivatives market is essential for the overall development of an economy. This is evident from the fact that while the equity market is the barometer of an economy's health and prospects, the commodity markets, including derivatives, play a much larger role as they encompass the real economy, and its growth contributes to real economic growth, incomes, and livelihood. Thus, it can be said that the commodity derivatives market provides twofold benefits to commodity value chain participants. First, it provides a nationwide platform for discovery of prices through interaction of market forces of demand and supply. Secondly, it offers a mechanism for dealing with price risk through hedging mechanism. Hedging involves buying or selling of a standardized futures contract against the corresponding sale or purchase respectively of the equivalent physical commodity. By taking a position in the futures market that is opposite to that held in the spot market, the producer can potentially offset losses in the later with gains in the former. Let me touch upon the history of the commodities derivatives market in India. The commodities markets, namely forward trading, has existed since ancient times. However, the formal trading started only during 19th century with the establishment of first futures market for cotton contracts by the Bombay Cotton Trade Association in 1875. Since then, India witnessed widespread development of commodity derivatives trading with the establishment of the futures exchange for wheat trading in Harpur in 1913, followed by Calcutta Assigned Exchange Limited in 1919, and the first futures exchange for Boolean futures started in Mumbai in 1920. Similar exchanges came up subsequently in different parts of the different cities of India. After independence, futures trading was brought under the regulation of Forward Market Commission with the enactment of Forward Contracts Regulation Act 1952, which has since been repealed. However, futures market was banned in 1960s due to deteriorating market condition in India. The ban got lifted in 1999 and subsequently Indian commodities derivatives markets were rationalized in 2003 with the setting up of demutualized national level multi-commodity exchanges. Then the merger of FMC with SEBI. Commodity derivatives market was brought under the regulatory purview of SEBI with effect from September 28, 2015, following the merger of FMC with SEBI. Since then, Indian commodity derivatives market witnessed a steady growth path and became a popular asset class for all class of investors, just like other financial asset classes like stocks and bonds. After taking over the regulation of commodity derivatives market, various reforms have been brought in by SEBI for the development and protection of interest of investors to further expand the market, increase liquidity with wider participation, and enhance ease of doing business. These reform measures brought in by SEBI can be categorized into 3 Ps, namely processes, participants, and products, which I would like to brief now. As far as processes are concerned, SEBI strengthened the risk management norms and introduced stringent surveillance measures to ensure market integrity. Similarly, SEBI also issued regulatory norms for strengthening the governance of the external commodity derivatives exchange to bring trust on the investors, and accordingly enhanced the transparency by making disclosure of category-wise open interest questions, annual performance of review of contracts, etc. Also, in order to expedite the process and ease of doing business, streamline the product approval process with every proposal of exchange to be required to be discussed and deliberated in product advisory committee, having a mix of cross-section of value chain participants, financial players, warehouse owners, etc. This was done mainly to ensure that the whatever products, whatever contracts which are introduced by the exchanges meet the expectations of the market participants. We have also introduced various warehousing norms to ensure presence of adequate infrastructure facilities. We also revised the norms for daily price limit to ensure that the price does not become too much volatile. Let me move on to the participants. The liquidity in any market is increased or maintained only by increasing participants. Keeping that in mind, SEBI facilitated participation of institutional investors such as mutual funds, portfolio managers, alternate investment funds, and eligible foreign entities which have exposure to Indian commodity markets. However, while some of the mutual funds have floated certain schemes exclusively for commodity derivatives market, The eligible foreign entities did not participate so far because of certain stringent conditions. We are in the process of reviewing that, and most likely, we are coming out with a discussion paper how to facilitate foreign portfolio investors to participate in this commodities market. Various measures have also been taken to increase the participation of FPOs, such as utilization of regulatory fees foregone by SEBI to benefit the farmers and FPOs by reimbursing mandi tax, assaying charges, put option premium, etc. Exemption to FPOs from imposition of all types of margins in case of yearly paying of goods in exchange accredited warehouses, and conduct of awareness programs through the resource institutions who have expertise in the field of commodity derivatives. Moving on to the products, it is very essential for any market to have many products, and as we have asset classes, so that diversification of risk is possible for the investors. Keeping that objective in mind, SEBI introduced new products such as options on commodity futures, futures on commodity indices in June 2019, and option in goods in January 2020. As recently as in Budget 21-22, SEBI has been given the mandate to regulate the proposed gold spot exchange. We are in the process of coming out with the detailed framework. The basic framework has already been approved by the SEBI board, and the details are already available on the SEBI website. We are in the process of coming out with the detailed operational guidelines to make this gold spot exchange operational in the next few months. Now, whether these reforms have actually helped developing the market, let us see some of the statistics. A look at the data reveals a growing trend in the trading activity in commodity derivatives market over the past decade. The trading volumes in the commodity derivatives are increased from 66,96,381 crores in 2015-16 to rupees 92 crores 22,927 crore in 2021, indicating an increase of almost 37% during the period. Further, the average monthly trading volume in the commodity derivatives for 21-22 as in October 21 stood at 8,05,951 crore as compared to rupees 5,58,032 crore in 15-16. This clearly establishes that the development reforms brought in SEBI has actually helped to deepen the market further. Now, having said that, the theme is for the day is what is the outlook for 2022, and let's see what is in store beyond that. As far as outlook is concerned from the regulator's perspective, I would like to place the following based on different sectors. Let us first talk about the agricultural sector. In the agricultural sector, the production is expected to follow an upward path as the current Rabi sowing is underway, accompanied by conducive weather conditions, along with ample buffer stocks of production, leading to containment of food grain prices. Moreover, we may experience improvement in the supply chain disruptions due to normalizing economic activity, increasing phase of vaccination, leading to relaxation of pandemic restrictions, etc. These factors are likely to ease the upward pressure on the commodity prices. I would like to identify three important thrust areas for the sustained growth in agricultural sector. First and foremost is adoption of newer technology. As we all know, this climate change and other issues which are being discussed all over the world, water is the scarcest resources after land for this sector. Investment in technology should continue to provide cost-effective, optimal use of water resources. The application of artificial intelligence and innovation in agriculture in the near future is paramount to speed up irrigation infrastructure projects, conserving soil fertility, and balanced use of fertilizers for enhancing crop productivity. Secondly, use of commodity derivatives market for price risk management by farmers and FPOs. The value chain participants have to be educated to manage their price risk by adopting the risk management tools like futures and options. In this regard, the success of option familiarization program launched by NCDEX for chana and mustard seed contracts increased the awareness about the benefits of the commodities derivatives market amongst the farmers and the FPOs. The exchanges have to come with such type of programs to draw the attention of the farmers and bring them to the derivatives market. Thirdly, though it is slightly controversial, consensus building amongst various stakeholders regarding various reforms being brought in by the policymakers like government and the regulators. The sudden intervention in the form of suspension of certain contracts recently on chana and mustard seed or the repeal of the formulas, etc., causes a lot of uncertainty. Such knee-jerk reaction should be avoided, as otherwise market participants will hesitate to enter the market and liquidity will be drained out, causing long-term damage. Moving on to the non-agricultural sector, let me share my views on the first on the energy sector. The energy sector, particularly crude oil, was the worst hit in 2020 due to lockdown restrictions world over, which had led to lower consumption demand combined with supply glut. For the first time, the price have gone into negative territory, and which was unheard of in the history of the price of oil. The crude oil prices have remained highly volatile. For 2022, the supply-demand dynamics in the energy sector are subject to several uncertainties. The consumption demand for energy is expected to be uncertain due to emergence of another variant of COVID-19, restored travel restrictions, and evolving effects of consumer behavior on energy consumption. On the supply side, there is uncertainty resulting from the production decisions of OPEC countries and with the rate at which US oil and natural gas producers increase drilling. As we all know, India has pledged to cut emissions to net zero by 2070, reduce carbon emissions by 1 million tons by 2030. Natural gas has been considered as a cleaner fuel. Hence, the government has a target to increase the share of natural gas in the India's energy mix from 6% to 16% by 2020. Trading in electricity derivatives are most likely to commence shortly, as both operational and legal issues have been resolved. Similarly, there is a proposal to commence spot trading in coal by establishing a coal spot exchange. As coal is already a notified commodity and is eligible for derivatives trading, once spot exchange becomes operational, the derivatives trading may also commence, and all these augurs well for the energy sector in my view. Moving on to the bullion sector. For the bullion sector, the key determining factor for gold trading and prices is tightening monetary policy of Fed and strengthening of US dollar, which may put downward pressure on the prices of gold. For silver, the long-term outlook remains positive with increasing emphasis on electric vehicles and solar power. It is expected that the proposed gold exchange would bring in both the large and retail players to the regulated market and thus bringing transparency in the price setting of gold, providing assurance to investors of the quality of the gold, along with giving a boost to the India good delivery standard. Moving on to base metals, the base metals assume significance for its contribution to industrial growth. Base metals do not have any production seasonality like agricultural goods. The demand for base metals in India has been rising and is expected to rise further. Now, in my concluding remarks, I would like to touch upon a few points. Given the uncertainties associated with the performance of the commodity sectors and movement of prices due to the ongoing crisis, the relevance of commodity derivatives market comes into play. The commodity derivatives contracts, that is futures and options, will provide a hedging platform to various market participants where the participants can lock in the prices at which they want to buy or sell the commodities. This helps in stabilizing supply variability and curtail undue price volatility. Since the world economies are undergoing recovery and restrictions imposed earlier are being eased out gradually, the entire economic activity, namely production, consumption, import, export, demand, supply, etc., is expected to revive. It is apparent that the ultimate objective of the commodity derivatives market is not only to achieve manifold increase in trade volumes and liquidity, but also to ensure that the liquidity so generated serves as a channel for percolation of benefits to the real sector. It is the fulfillment of this objective that shall be the true test of not only the performance, but also the very relevance of the commodity derivatives market. As a regulator, we are always open to new ideas. I therefore request all the participants in this event to do a deep dive and deliberate on various issues while, while discussing about the outlook for the commodity sectors concerning that market, and share the takeaways from this event with the stock exchanges as well as with the regulator. This would enable us to take further appropriate reforms to deepen the commodity derivatives market in India and buttress its global stature and repute. I thank the organizers once again for inviting me to share my thoughts on this occasion. I wish all of you a very happy New Year 2022. Thank you once again.
Thank you very much. That was very enlightening speech. You almost handheld us through the history and whatever is coming up. Before we could start, I think I was joking that you could probably break some news. I think there's quite a lot to write about on what's happening on the commodity front. And as you said, commodity markets have been really resilient. They have been true indicators of what was likely to unfold in the future. And we see such a trend also for the next year. And also, as you said, I think SEBI was under tremendous pressure this year because of rise in some of the commodities like soybean. I think SEBI was under tremendous pressure where pressure was being put on from all fronts. But I think SEBI acted very smartly. I think SEBI was right on the ball in handling the situation beautifully. So thank you very much for this enlightening speech, and we look forward to Happy New Year for you also. Now we'll get on to the business session. Without much delay, the first session will be the energy session. Energy commodities play a key role in the prices of other commodities, particularly agricultural crops. Crude oil prices have increased over 47.5% this year, with Brent crude hovering near $75 a barrel currently. Prices have come off the high seen a few weeks ago since there is an uncertainty over the impact of Omicron variant of coronavirus. There are fears that there could be an oversupply. There are fears that the first half probably could see this scenario unfolding. There could be even a potential divergence of views or opinion between OPEC Plus and non-OPEC crude oil producers. There are also geopolitical risks, however. Russia and Ukraine are at loggerheads that could see the US coming in favor of the latter. There is China-Taiwan tussle that could probably see the US, Japan, Australia, and others coming to the rescue of the latter. The Iran-US nuclear deal is also hanging fire. Now we'll have to see how the scenario will pan out. There are also some economy factors, as we said earlier. So these are the things that we'll have to watch out in the crude oil market and how it behaves. This year had been a phenomenal one. And as a major importer, India had to really stretch its budget. So that is also a concern for all of us. Most of us are paying fuel at almost 100 rupees a liter. So let's see what is going to happen from our panelists. Unfortunately, Mr. Amit Kumar Sharma, Director, Structured Products, LNG BP Singapore, who was to talk on the fundamentals of the energy sector, is not available. He has had some personal problems, so he's been unable to make it today here. But we are extremely thankful to Mr. Sukrit Vijay Kumar, an IIMA graduate, for accepting to address this webinar at the 11th hour. Vijayakar has been trading in the markets for over 30 years. At least 20 years of this have been in the energy sector. He has worked with two of India's biggest refiners, and he has been an advisor to a major public sector refinery. He has also been guiding many market players, including international ones, on strategy, business planning, best practices for procurement, distribution, and derivatives trading. Before Mr. Vijayakar takes over, I would request all the viewers to send in your questions with your name and designation. We will take the questions after both our panelists finish their presentation. Now, I welcome Mr. Vijayakar to present his views. Over to Mr. Vijayakar.
Thank you, Mr. Subramani. Well, I've been called in at short notice, so I don't have too much by way of charts, etc. But I'm going to try and put it to you in the way you and I think. Most of us in this discussion are largely upper middle class. We use our own vehicles for transportation. We fly from one place to another for business meetings. And, the feelings that we have are quite, in general, quite reflective of the world at large. So let me just start with sharing with you this slideshow. Is this visible, Mr. Subramani?
Yeah, it's visible.
Okay. So in the first slide, we're just looking at price movement since August. This was a trough. Now, from here, one second, it moved to a high of around $86, plunged to a low of around $68, and we're starting around $60 here. Okay, moved to $75, and now it's trading around $73, $74. Now, you just think of what has been happening in the period between August to now. Has there been any particular difference in the way you've been living life? I mean, things have generally been easing from a tight government lockdown to some extent. But is that enough to merit a 25% increase in prices? If you believe it is, then is just the discovery of this Omicron virus enough to drop prices by 10% in one day? These are just thoughts I will leave with you. The obvious answer is that it isn't. So we need to take prices with a pinch of salt as to not reflecting the actual ground conditions in the present. Prices tend to exaggerate expectations of markets as to what will happen in the future. So when we are discussing about prices, we need to keep this at the back of our mind. So let's look at what are all the bullish factors that are in favor of a price rise from here. We've heard about mega cycle and demand will increase to pre-COVID levels, etc. So what are all these factors that are affecting it? The first, and you will have thought about it even as I asked the question, is that OPEC and non-OPEC producers have adhered to quotas. What does it mean? It means that there is supply in the market, but it is being withheld. And these guys are willing to withhold supply further if they believe that prices will come down. Now, I don't know how SEBI looks at this, but it is what you call hoarding or price manipulation, really. Let me just declare at the start that I am a biased spoiled bear, have been that way due to my profession for the last 20 years. I've been primarily in the risk management field, so I'm worried about prices going down. So I mean, this is what is likely to send prices up. If prices go down, OPEC might suddenly say, I will stop increasing supply. Second factor is that demand is undoubtedly strong and growing. Look at it yourself. How many of us have itched to travel and have traveled as soon as lockdowns have eased to some extent, and even if they haven't traveled much, would have loved to travel more and are feeling frustrated by the prospect of future lockdowns coming as a result of this Omicron variant. So yes, there is demand, and in the US, the demand is very strong. In fact, the demand is so strong these days that it is in excess of some 10-year levels of demand. The exact number fails me. I'm not going to put too many numbers before you because, as Stephen Hawking once said, any book or lecture on science immediately loses the interest of the audience the moment you start putting a formula in it. So I'm going to keep to general principles and talk to you in a manner where you can sense what is going on from your personal experiences. As I said, this audience is part of a generic set of people who comprise what creates supply and demand for the market. Mr. Subramani and Mr. Venkatesh had also said that geopolitical uncertainty always remains as a factor that pushes prices up. The war between Saudi and Iran with the US in the middle is well known. Israel is also a factor out there. Then there is China, there is Hong Kong, there is Taiwan. All these things can blow up at any point in time. And last but not least is the nature of financial funds. These funds actually look for an excuse to move the markets in one direction or the other. Anybody who believes that they are actually working only basis their beliefs is slightly naive. I mean, yes, I will grant that the funds are moved by things that move you and I, but the funds take such massive positions that the move gets exaggerated. As I said, what happened between August and November to move prices up 25%? Has anything really changed? Has it changed so much? People were talking about $100 oil then. And I will come to that, that aspect later, saying that there may not be enough supply. I will come there in a little while. But funds normally, and all of us, you look at your personal trading in the stock market, people are always happier buying rather than selling. Exchanges also tend to regulate short sales far more than they regulate leveraged buying. Okay. We'll now take a look at some of the bearish factors. And the first one, obviously, is the impact of Omicron. Now, the Omicron variant, I have a batchmate of mine from IIM Ahmedabad who is a professor in Cornell University. And he was sharing with us yesterday that they have a strength of around 900 in the university, out of which around 50 to 60 or 70% has been vaccinated. Having said that, the number of Omicron cases that cropped up, and some of them of such severity as to knock people off work for a couple of days, has been huge. And it is reasonably safe to say that vaccination hasn't been too effective against the Omicron variant of corona in the US. Having said that, let's look at another parameter that I tend to track, which is daily death rates. The daily death rates at the peak of the Delta variant of the virus reached around 15 to 17,000 a day. For the last 5 to 6 months, and I'm talking globally, mind you, last 5 to 6 months, they are always well under 10,000. And this is after 2 weeks of Omicron, which is sufficient enough for Omicron to have created a telling effect on the number of deaths if it were as virulent as people proclaim it is. So my sense is that Omicron is livable with, and in a country like India, it is even more livable because we have a better resilience to disease because simply we are more exposed to it, and the government has been very careful in controlling movement and vaccinating people, and hats off to all state governments who have all done their bits in making sure that this goes through. The next aspect I'll touch on briefly as markets return to, let's look at the basic components that affect us. One is petrol, the other is diesel, and third is jet fuel or kerosene, which is used for flying. So in terms of petrol, a lot of us drive around, a lot more people drive around more because they're scared to take public transport. As if and when the governments deem it safer to open up public transport, one would expect that the demand for gasoline would be abated even as more people come out in cars. The number of people turning to public transport from cars and two-wheelers would be significantly higher. So gasoline, I don't see too much happening in terms of demand increase. The next aspect is diesel. Diesel, you will see some growth, again, largely seasonal with agriculture and so on and so forth. Power or transportation, you are seeing a number of electric vehicles populate at least the metro. I'm not sure how much around India, but in Mumbai, where I reside, the number of electric vehicles coming into the market has been quite large. For jet, that is the only area for concern. People are still hesitant to travel internationally. Rather, countries are hesitant to welcome people from across the border. Somewhere this morning, I read that Bali had less than 100 visitors, or some such ridiculous number for all of 2021 when it opened. This is a fact of life, and jet is likely to be impacted more than any other product. Last but not least is money supply. Inflation in the US has been at multi-year highs. 6.8 inflation is something that they haven't seen, this generation hasn't seen out there. The producer price index is also very high. So yesterday they have decided to plan for 3 interest rate hikes, which the market expected. I suspect people would need more. There is always a tug between controlling inflation by hiking interest rates or curbing money supply and keeping market confidence. And that has been the battle ever since 2008. You've seen QE, QE2, etc., etc. I will leave you with a few thoughts, just a couple of them. Here, those of you who are from the refining industry, just think back. Whenever you've been looking for a cargo of oil, and I've seen $147 oil, I've seen $40 oil, I've seen $100 oil, I've seen $20 oil. No buyer of oil has ever been stuck for a cargo whenever he wants. So all this thing about oil being in short supply needs to be taken with a severe pinch of salt. And that is what today you have OPEC having spare capacity of what, close to $2 million barrels per day. The US has a spare capacity of at least 1.4 million barrels per day from their maximum level of production. And what is more, the the efficiency of oil rigs has been improving. So the number of oil rigs that are coming in, you're going to see good production. So I don't see market really being short for oil. The demand is more an issue than supply, which is why I haven't I haven't stressed too much on supply. And this last thought, that the oil market is probably the only market in the world where we share a bunch of orders. Basically, we like it when prices go up. We say it is a sign of good demand, etc. Why? Again, this is my bias as a bear, so I will leave that with you. Just in case I publish a blog on the oil markets every day. In case you wish to subscribe to it, you can write to me on my email address and I will add you to my mailing list. My website is also below. And I hand it back to Mr. Subramani. Thank you for calling me even at such short notice to address this August gathering. It has been an honor.
Thank you very much, Mr. Vijayakar. It has been an enlightening views from you, and you had covered almost all the gamuts, like what are the advantages, what are the risks, and what we can look forward to. There could be some questions. We'll come to that when the question and answer session comes. So that was really very nice of you, and also we thank you again for stepping in at the 11th hour. Now we'll now have Mr. Matthew John making his technical presentation. Mr. John is Director, Technical Research, Alumnus Risk Consulting. Over to Mr. John. Hi. Not able to hear. Unmute.
Suggest you take off your headset. It might work better.
Hello, are you able to hear me?
Yeah.
Thank you.
Yes,
Thank you, sir. And just like Mr. Sukrit said, I will also keep things very simple. It is technical. I'm asked to project, charts in the long term and all that. It becomes very difficult, and it is a very complex process. So I've summed up a few slides, and I tried to project prices with a very simple description. Can I just share the screen?
Yeah.
Thank you. So the basic framework, basic framework is task force price force Q1 2020 to me. And for this, I'm having slides, just 10 slides, and I've got probably minutes.
Mr. Matthew, a bit of break in your voice.
Hello, am I audible now?
Voice is breaking.
Am I audible now?
No, it's gone off.
Am I clear now?
Yeah.
So I basically use simple charts, just bar charts and trend lines, nothing else, no transforms, no oscillators and all, because I understand the audience is a bit fundamental mix and other are following other commodities too. It becomes a bit cumbersome if I use all my indicators and all that. And I will use intermarket analysis to clear the noise part of it for confirmations, which is kind of John Murphy kind of simple intermarket analysis to confirm the price of where crude prices are going. And I'll use, so the best software for this is to use Microsoft Power BI, because this gives you the easiness to, plot different kinds of charts, axis of time. This has one, also you can plot, you can do your price coding, you can you do your quant thing. In this, your analytics kind of a module there which you can use. So this is the basic framework. And coming to the most important regime change that happened of oil, sir said why Sukrit sir said why oil prices have been going up. There has to be some reason behind it, and it looks like there has been a regime shift because of underinvestment into oil. Probably people would people or economists who invest, of course, capital allocation, but forgot the doctrine, which is social responsibility of business is to increase its profit, not to do all other things. Because if you do all the other things, the metrics change, and it's very difficult to to actually measure it and do better capital allocation. I'll show that in charts. Just 1 second. And the proximate cause of this price movement has been it started with the turn in the graph of crude oil from a low to high. Happened with the President Biden getting into his presidency, and he had a green reset. Immediately after being president, he stopped Keystone Pipeline. He banned all kind of shale drilling in federal land. And the next important thing was one Hurricane Ida and other German election, where they had to take help of the Greens. Now, putting all that into these charts. Now, I look at commodity cycles. We need to look at commodity cycle. Oil by gold, which will give you a better indication of commodity cycle. Every 5 to 6 years, you have this low made. There's been some slight disruption here. This is a low. This can be an exaggerated low. This is a low made. Now, during the underinvestment into ESG, this is what has happened. The price of oil came down. Suddenly, we found that there is no supply of oil, or whatever be the reason. At least the traders could take it up. Now, let's confirm whether this is happened with this is just because of oil supply, or this is that with shortage of supply. Is it that what global economy is covering? That copper to gold ratio, and see how it works. Whether the equations align. One second. This aligns perfectly. So this is not just an oil supply thing, but also throughout global expansion. Dr. Copper is supposed to, guide us or give us a better visibility into where global economy is heading. So this aligns perfectly, and we have an upcycle in commodities, in copper, in oil, and all that. And this is how it is. It becomes visible here. Now I'll come to the next one, which is a proximate cause, which is natural gas. Now, crude oil and natural gas has a very, very kind of love-hate relationship. So sometimes, most often, it is the rise in crude that pushes up after a lag, pushes up natural gas prices, and this is shown in this graph. You can historically it is kind of we call a co-integration. There have been many studies how natural gas after a lag pushes up. Of late, what happened? Hurricane Ida, the price of crude was coming down, natural gas started peaking. Perhaps because of the supply sudden getting off of supply from Hurricane Ida in the US, Gulf, and all that. But the prices starts increasing, and it pushed when the crude prices was coming down 2-3 months ago. The price of natural gas pushed up crude prices. Why this is happening? The speculators, there is a very interesting that is happening. While this is moving up, we can see that both natural gas and crude price moving up in step. And while this is happening, natural gas prices, this is the CFTC data of natural gas and the speculator position. Whenever natural gas prices move up, the speculators actually go long. This is a longs. The price doubled from 2 to 4. 0.73 doubled to 3.35. 3.40. So the price goes up, the CFTC data, the net speculators go long. But this time, what has happened is speculators are going short. So coming back to this chart, in context so that I can charts. This is what happened. Johnny said in Lovers meeting, Shakespeare said, the same thing happened and the prices came down. The technical analysis chart. I put a very simple resistance line. This is the resistance line from the 2009 levels. Probably technically a double top and all that. It came down. It again resisted around this 80, 85, 86 levels. Again, this time the rally kind of concluded, at least tops are now around the 83, 85 levels. If you look at these cycles, again, these cycles are visible, around 5 years, 6 year cycles are visible. You can do Fourier analysis and all and do the phase thing, that becomes a bit complicated. But if you look at the low to high, number of months it takes is around 36. Here again 36. This rally has only been truncated, at least for now, truncated at around 24 months. This is a very important assumption and very important implications. When this happens, what will do? This will most probably go sideways for some time, and this is the target for the long term. So it doesn't mean that it is Q2, Q3. It might be further beyond that, because it needs to take the time cycle to its in its stride and then move up. It will take a bit of time. Maybe Q2, Q4 will hover around this level and then suddenly move to the 115, 120 levels. That is what the chart shows. I have other studies to do, but if I put that, it becomes very complicated. Now, for confirmations, this is another confirmation why I was feeling a bit bearish, at least for the time being on crude, is because this is dollar carry. Because we almost use a lot of intermarket analysis because we are in forex and commodities. This is dollar carry. If oil is going to make a new high or going to break free from that 80, 85 levels, that would have meant that the Canadian dollar should have strengthened. It didn't happen. This is despite the fact that the Bank of Canada ended its QE and also gave guidance that they will be hiking rates. So this is one confirmation. It's kind of dollar carry is on the, of course, the inverse. It is not breaking down. So that means that the oil, at least for now, is kind of finding an equilibrium level where 85, 87, around that level becomes an upward cap. This I made just today. Right. So this is a channel that has been holding this rally. Lows made in 2020 to the highs. Channel is also showing that it is kind of resistance, and in fact it is not having the strength to move up. It is kind of taking this. So oil for Q1 prediction is that it will be around 2 and 5 and all takes all that, we have a lot of algos and all that.
Mr. Matthew, again, can't hear you. No, we can't hear you. No. Yeah, please go ahead.
Yeah. So this is a basic projection. So it should hover at least in Q1 and towards the end of Q2. It should be moving. It should be moving up and down between 58 and 86. And most important thing is that for oil, and this wets Sukrit's caution that oil is kind of bearish, at least for now. The reason is that we have a situation where the Fed and all that is hiking rates, yields are moving up, dollar index is moving up, and oil is also moving up. This cannot happen. It has never happened in history. There's just one time when oil and dollar index moved up. That time oil prices again, just crashed. So if you look at history, it doesn't have oil and dollar index will have to move in the opposite direction. So at least for now, the dollar index will put a fundamental cap on the price of oil. So this is the fundamental view shown in a technical graph in an intermarket analysis. Just one more slide. Then the most important thing is, now I will take the political dimension, how it happens. Look at the 10-year break-even inflation in the US and the Brent price. I just plotted it. Of course, the rolling correlation may not give the right amount of correlation because each month might have a different reading. Correlate perfectly. The visual presentation of this. The display is very clear that the US inflation has a direct big correlation between to Brent price, and it is also logical. That is the case. What will happen? What will be the political reaction to it? So President Biden, of course, is down in popularity. I have made a slide deck, a supplementary slide where I have shown all the slides. President Biden's popularity rating, what is the ESG problem into oil markets and all that. We can see it separately. And this is what President Biden had when inflation is directly linked to the crude oil prices. He will be under pressure to release the US crude oil. So this all happened around this part. So that is area where we kind of turned bearish, and then only point is that this will come, make a dip, hover around for 1 or 2 quarters, and then start moving up. So the most important thing, which again was touched upon, this is the Fed's reaction function, which obviously in mathematically it is, they have called it the FATE, the average inflation targeting. Inflation rate is 3 times more than what their target is. They want it above this or symmetrically above it, but it's not just symmetric, it just, gone way over. And this is the employment rate where they ask, where they say that, they would like substantial further progress in employment. Their last year, their full employment idea was around 4%. Now I think they have mathematically made it into 3.8. We are reaching there. So they will be under tremendous pressure to hike rates. When they keep hiking rates, it's very difficult for oil to suddenly burst up and move. Only condition is what is the point at which oil prices can break 80, 85 levels and move to 110, 150. That's this graph. This is the trade deficit in the US and the dollar index. Now we can see that normally last few years at least there's been an equilibrium between trade deficit and dollar prices. Now look at what has happened. The dollar index is moving up. It is gaining in strength because of the rate hike, pricing, and all that. Trade deficit is moving down. There comes at a point at the dollar index graph I looked, it is around 99.60. At a point where there will be an inflection point where commodities after this slide in the next 1 or 2 months will start again one more bull rally. That will coincide with perhaps Fed making a mistake. What Mohammed Al-Arian recently said that because Fed is so behind the curve, they will start raising rates that the whole US growth will suddenly slump and go into a recession. That is exactly what the 2 years and 10 years are all pricing in. That I have the slide desk. There are a lot of things, especially on ESG and all, how Professor Tom and all being critical of the ESG metric and all that. I put all this in the slide desk. Anyone who wants it can either, there should be a facility to take all the slides from us. And that's it. So basically, in conclusion, I try to intermarket different markets analysis in this full way, put the behavioral question of, and try to, without hedging, try to make a prediction on the. So I think my time is done, and I session has been informative. At least put some perspective on the various markets and how it affects in at least a visual way. Thank you.
Thank you very much, Mr. Matthew John, for that, for those enlightening views. I think we had a very interesting session, and now we are opening the floor for question and answers. Now, I would address this question to Mr. Vijayka. Now, we have heard that the winter will be less harsh this year. What sort of impact will it have on the prices of dollar? I'm addressing it to Mr. Vijayka.
Yeah. So this winter will be less harsh and all. This is a standard annual dance that goes on. It's part of playing the markets in the crude. So people tend to say winter will be harsh, so markets will be up, and then winter, if it is milder than expected, you will find crude trickle down. Actually, it is not crude which is so much an issue. It is heating oil, and in Japan and in the East, it is jet, because jet and kerosene is used for heating that side of the market, and that is another problem with the impact of mild winters on refiners. The jet margins are already affected by the reduction in travel. And if there are mild winters in Japan, Vietnam, that part of the world, and those temperatures are already coming in milder than initially projected, it does not augur well for that part of the barrel.
Thank you, sir. Now, I would ask this question to Mr. John. You've talked about oil and dollar index going up, and then it has now come up the highs. Now, what does it portend? Because now, next year, US dollar is seen gaining. So, how do you see crude oil going? Behaving? And is there any possibility of you saying what could be the average price of crude oil next year? No, I'm only asking you to. Need not answer, but
quarter one, at least January, March to June, that quarter it doesn't look like it will have the break 85. But suddenly it will be like, for example, the most important event that I think geopolitically has to have a geopolitical because when economies are going to come back after COVID and the whole travel and all come back. It is just crude will have to go up, but also that the crude will also have all the central banks. If you look at IMF data on inflation, I think I put it in the slide. All of them are showing very high inflation rate, far away from their core targets, central bank targets. So they will have to keep interest there, and that gap on crude at least for now. Point is, then that
can you come again? We are not able to hear again. Breaking. No. Yeah. No.
Yeah. Is it okay now?
Yeah, probably you can take off the headphone. I think because once off the phone, I think we are able to hear you much clearer. No. No, just the wave.
Okay.
No, going off, on and off.
No idea.
Now you're getting it.
Yeah. So there comes a point where it has to be geopolitical. The break of 85, 88 on that line will have to be geopolitical, and I think most likely it won't be Iran, US, or it would be Russia, Ukraine thing, because that is where Russia will be able kind of build up their doing in Ukrainian border. They almost call all reservists. So that it wouldn't happen in the peak of winter. It would have to be somewhere around the Q2 kind of time. That would be one geopolitical event that can happen. Second thing is oil prices breaking out is maybe China recovery. That is all will have to be calibrated with interest rates, moving up. So it has to be a geopolitical that triggers oil up.
Okay.
So the average price would, of course, Q1, Q2, you have put an average price would be around 75 to 70. That would be the average. Later, price will start spiking up. Then the average rate, of course, becomes higher.
Okay. Thank you very much. Now, to Mr. Videkar, I have this question from my colleague, Senior Associate Editor, Richa Mishra. He wants to know that what can be India's capacity building to meet the demand. Currently, the reserve capacity is only 9.5 days. And how can the cost dynamics work?
This is slightly beyond my sphere of expertise, I'm afraid. But again, as I've told you, there is no reason to really be so afraid about a reserve. The amount of spare capacity lying around in the world that is unused is phenomenal. And even at the worst of times, there has never been a problem finding a barrel of crude for any refiner. So we are not going to, I personally don't believe that we are going to be in a situation where, your refineries will stop working because there is no oil. The reserves act as some kind of price cooler, if you will, because if I have this kind of stock in my backyard, I will simply not go into the market and hopefully reduce the demand in the market. These pushes and pulls keep on going on because there were talk about the US releasing things from SPR and China and Japan, and everyone ended up saying that, okay, you'll release it now, but you will have to replenish it some point in time. And what are you going to do at that point in time? So how much of a reserve is enough? It's just a matter of, how much savings you feel are enough to keep you comfortable. And there is no right answer to that. Everyone has to be happy with his or her own level of reserves.
I would ask another question to Mr. Vijayakar itself. This is from Mr. Somnath Nag. He wants to know what are the parameters that need to be focused on when investing in natural gas.
Okay. So when you are investing, see, whenever you're investing in any commodity or anything actually, you have to look at a supply and demand, likelihood of disruptions, and you are not investing as a consumer. You are investing as a financial player. So you're looking on return on investment. So you are looking at things like diversity of your own portfolio and momentum. If you invest in natural gas and it doesn't move while other markets move, there's not much point. As one very respected analyst in the capital markets mentioned once, that the year of 2021 saw FDs giving you a good return on the best returns on investment. And that is something that is routinely pilloried by everybody who comes. So every market has its time, and you can take it because you fancy it. I mean, you ask me, I don't invest in commodities. I just don't like them. Okay. If at all I want to play around in markets, I'm happier playing in equities. So it is entirely a personal feeling as to where you should invest and why you should invest.
Okay. Mr. Matthew John, this question is addressed to you by Mr. Sachin Juneja. He wants to know what is the projection for crude oil for 2022, minimum, maximum, and average. I think it's a tough one, but still.
Same way, the average price will I think even if it spikes up, it will then come down. So the average price should come around 75 to 80. Okay. That is the equilibrium price which everyone would be like a win-win. It's a game. It's like a game theory. Biden doing this SPR release, Putin and Saudi Arabia is in the getting the wrong. When the prices come down, they will do their stuff. So it is always game stuff that goes on. But at around 65 to 75 or in around that level, I think the whole world will be like a win-win kind of. So that would be the equilibrium level, and that would be the average price. So projection is the price goes there and it comes down. It wouldn't help anyone unless you are a trader. So we all. It's very difficult to catch it. That's why, like Sir said, most of us trade commodities via stock market. So we take the correlations and try and. So this is the. Average price is different. The projection for the time. See, I can say, it reached there. See, I have done that. I've correctly predicted, but it doesn't help anyone. The average price would be a bit down.
And we have one question again to Mr. John from Mr. Ravi Gupta, who will be speaking in the next session on agriculture. Now he's saying he's having two things. One, he wants to know what's the downside for oil prices from here, and the other thing he's saying technically, fundamentals are difficult to predict.
Different outlook. So although I've shown these charts, it's just for the visual presentation. We use an entirely different indicators. We use a lot of mathematics.
No, again, not clear. Little more. No, I think little off. No.
Okay.
Now fine.
Hello.
Yeah, fine.
Yeah. So we use entirely different set of indicators to just project, which includes transforms, transforms, and all that. So fundamentals, I just to show what is the interrelations between market. That is visually pleasing. And of course, these are all in the backdrop, but the actual projections and the time of attaining the start from technical studies. The lower side of it is crude can even go low. 62, 58 would be the lower side of it in the normal projection. Substantial 3 standard deviation thing, you may even get into 49. That is the minimum. That is the maximum downside that can happen.
And one final question to Mr. Vijayakar. This is again from Mr. Somnath Nag. He wants to know whether crude oil is the driver or inflation is the driver of the
driver
market.
for what?
Market. What is driving the market, crude oil market? Whether it's crude oil itself, the fundamentals or the inflation part of it.
Actually, what is driving the market is the hunger for profit. Where do you make money by movement? And then you consider the impact of demand, you consider the impact of inflation, and these move the markets. It is not the driver. The driver for oil is the need to make products which we are going to use. Now, that doesn't change overnight. The movement in demand or supply, supply, yes, but the movement in demand doesn't, work in a blink. Supply does tend to move in a step function kind of thing, because the suppliers are consistently trying to evaluate what is happening in terms of the market demand for processing. So if they feel that there is too much, they reduce it, and they want to reduce prices further. You look at one reaction in the market. Just this month, Saudi Arabia hiked its official selling prices. Now, what should be your reaction to that? For a refinery, it means that my margins will decline, because unless I can get this increase in price from my entire barrel, my refining margin is likely to drop. So it should be bearish, right, for prices. That's not how the market sees it these days. The market says that if Saudi Arabia is increasing the prices, it means that Saudi Arabia expects prices to rise and markets to make good money from refining. So it wants a share of that refining margin. Therefore, market should be bullish, and therefore prices rise. Now, a simple piece of information can be interpreted differently by different players in the market. So there is nothing about driver for the market. Everything is driven by the EFGH of trading: emotion, fear, greed, and hope. Those are the drivers for the market.
Okay. Fine. So next time if somebody is going to say EFGH, we know that what is it all about. Thank you very much, Mr. Vijayakar and Mr. John, for your very insightful views, and I hope those who have tuned in would have got some idea of how crude could behave next year. Now it's time for us to move to the next session. Thank you. Yeah, thank you very much.
Thanks.
Yeah, now we are moving on to the second session, which is on the outlook for the agriculture commodities, in particular agriculture. Agriculture commodities have had a wonderful time this year. Indian farmers have been one of the most, one of those who have benefited a lot from whatever has happened in the agri-commodities market. They've got record prices for soybean, cotton, coffee, pepper, and even corn, though they have never touched the MSP level. To put in the proper perspective, soybean is right now down, but for major part of the year, soybean was rolling very higher. Wheat has gained 18.8%. Palm oil has gained about 21%, though they are off their highs. Even cheese and milk have gained. Milk has gained about 17% globally. Canola, which I think we can relate it to mustard, that's got about 60% up this year. Cotton is up by 36%. Rice has gained about 11%. Tea has gained almost 5%. Coffee, 84%. Oat is also gained, is almost double. And corn is up by 21%. I'm saying on the year-to-date level. So they've all gained. So what we've seen is that this has really helped Indian growers, though it would not be right. This may not be the right form to talk about farm reforms and all, but probably that's an opportunity lost for the Indian farmers. And then what we saw is that they were concerned over edible oil prices. They were virtually on fire this year, and that was really leading to a complaint from the consumers. And we have seen what's happened with inflation last month. These are all results because agricultural commodities have really performed very well. Now, it's time for the first panelist to step in to give us views. I now invite Mr. Ravi Gupta, Director, Sri Renuka Sugars, to make his presentations on the fundamentals for the agriculture sector. Over to Mr. Ravi Gupta.
Hi. Can I request somebody to switch on allow me to start video? Yeah, this is better. So good afternoon, everybody, and thank you very much for inviting me to speak about the fundamentals of sugar market. I have tried my level best to bring clarity to the whole subject. So I was asking Chandrasekhar, who coaxed me to this accepting this speaking, and I asked him, I said, price forecast in this environment is impossible. So he was saying that you speak about the fundamentals. So I'm going to talk about the fundamentals, which is the right thing to do. And I have made a couple of slides for all of you, which I would like to present for me. Just give me one moment so that I can put that in order. Just give me one moment. One second. Are you able to see the slides by any chance?
We saw we are able to see, but now it's gone away.
Just give me one moment, please.
Yeah. Yeah, we are able to see that.
So this is the small few slides I have lined up for you. It's the fundamental on sugar price outlook. To me, the sugar is so now hooked on with the energy, the crude prices, that it is all about the energy play. So I have divided my presentation in two parts, because one is talking about a little bit about the global market, and second is about the Indian sugar market fundamentals. So let's start with the global market first. And I'm not able to flip it. Yeah. So in the global markets, basically the whole fundamentals of the sugar markets will be working towards the crude play. So the sugar markets will tend to follow where the crude prices are. And to just explain that point, if you look at it last history of around 2017 till now, you will find that the orange graph is the graph for ethanol, and the bar chart is for the crude oil futures. Barring in the year 2018 and 2019, when the world had surplus sugar, world had a surplus sugar of 9 million tons in 17-18 and 18-19 around 2 million tons. That time the ethanol started playing independent of crude because the sugar prices went lower. But when that thing got corrected and world became deficit from 2020 onwards, when I say deficit, is milk production minus consumption, the ethanol is exactly showing the good correlation with the crude oil. So this slide is basically to make a point that in the times when the world sugar and supply demand is balanced or in negative side, the ethanol and crude oil prices go hand in hand. Similarly, if we go next, this is the graph for the sugar prices and the crude oil prices. This will also give you a very, very similar picture that as when the world is surplus of sugar, sugar start trading its own fundamentals. It gets it gets de-linked with the crude prices. But when the sugar balance sheet is basically tight, if you see the red bars below, that is 4 million tons production minus consumption deficit, then 9 million ton and expected 4 million ton the next years. So when the balance sheet is tight, again, sugar also filed crude. So what it basically, to simplify, what I want to say is that it's like A equal to B equal to C. If A is equal to B and B is equal to C, A is equal to C. Here A means if crude is equal to ethanol and ethanol is equal to sugar, so resultantly crude is equal to sugar. So this is which we are likely to see. And why I say that, this is a little bit complicated bars. If you look at it, 15-16, the world was deficit. 16-17, world was deficit by 2 million tons. And in 17-18, 18-19, the world was surplus by 9 million tons and 2 million tons. In last 3 years, there is a deficit in the sugar market, which means that the production minus consumption, there is less production as compared to the consumption, which means the world has consumed sugar from the stocks. And going forward also, I believe, I have not put the numbers because of the paucity of time, but going forward also, I believe that the world production and the consumption will barely match, or rather it will be a deficit kind of situation. The reason being are two for that. Number one is that the Brazil has reached to a maximum crushing capacity, which it did just 2 years ago, around 600 million tons. There, the scope of increasing the capacity is little less because the new investments are not taking place. Existing investment in the sugar mills are still facing challenges. So the Brazil has in the short term very less capacity to produce. India, with its ethanol program, which is getting bigger and bigger, which we will also discuss subsequently, have very less sugar to give for the world market. If you look at in last 3 years, India has given around 19 million ton sugar to the world market by way of exports, which basically, met the deficit which we have seen. But going forward, we will discuss subsequently that India will have less sugar to give. So in the global market, I see a scenario that the deficit will continue. A lot of people talk about La Nina. So in the La Nina, I think the situation is looking a little bit better than what it was expected a few months ago. So when the temperature are below minus 0.8, that's a time when we say that La Nina will impact and the weather will get impacted, which was the case in December and likely to be in January. But going forward, the forecast of La Nina is becoming a little bit normal. Having even said that even if the La Nina situation improves, but I do not see Brazil, bouncing back on its production of sugar, because last year the cane suffered because of the frost as well as because of the dry weather, and the limited plantation there will not let the sugar production move very high from the last year. So we are expecting around 2 million tons higher production next year, and it may not be more than that. So even if the La Nina does not impact in the coming months, I don't see there will be a big push of the supply out of Brazil, and it will come back to 38 million, which it was last year. That situation I do not see happening. So now coming back to what could be the factors to watch. As I explained that the world has consumed a lot of sugar from stock, production minus consumption has been negative in last 3 years. And going forward also because of the limited scope of increase in sugarcane in Brazil, sugarcane crushing in Brazil, and also because the India may not have surplus, which we will discuss subsequently, I see that the sugar balance sheet, global sugar balance sheet will only get tighter. So that's one of the bull factor. Funds have big appetite to build up, further longs. I think the current longs, they are around 140 and they have the capacity to double it and more than double it if they see an opportunity. Weather is very, very unpredictable, very difficult to predict. If La Nina again comes back and shows its face in the subsequent months when the Brazil crop will be in the ripening stage, it can create a different kind of situation, bull factor. Another factor which is prevailing, that world needs Indian sugar today, and Indian sugar is not available below 19.5 cents. So currently the world prices are hovering around at the same level. And I think, so this is the base level at which world can probably find Indian sugar if they need it, which they need. And in terms of bearish factor, the biggest factor is the demand destruction. Tomorrow, Omicron or any other viral situation brings to lockdown, and there is less consumption of the fuel oil, there is less consumption of the sugar. It can change the situation very, very fast. When I say volatile energy prices, I meant crude here. I do not want to forecast crude, but I think BusinessLine has done a good job by making crude oil experts speaks. And if whatever I understand from them, the market seems to be quite uncertain. I love Sukrit's presentation, and where he's saying that financial funds have appetite, geopolitical uncertainty can come in, and also the OPEC has not increased the supply in spite of so much pressure. So on the bull side, these are the factors which are there. Our technical expert also mentioned about the crude range of around $75 average. So if that be the situation, then at least the prices will be stable. And if the crude price moves up, it can only go higher. Inflation and interest rate will always be a threat to the commodity markets. But that is something on the bearish side which we need to watch. So these are the few factors which kind of I will believe that one should watch carefully. But it is very difficult to forecast a price. But if what I see as of now on the bull factor, which seems to be more visible, I think the market should remain stable to the bull level. Coming back to the Indian sugar markets, which is very, very important. Like the world market is all crude oil play, Indian sugar market is total ethanol play. What has happened is that the Indian ethanol program is the fastest growing program in the world now. So we have taken our program to roughly 6 times in last 4 or 5 years. And the government of India has a very, very definite roadmap released by the Prime Minister himself on the World Environment Day to bring 20% ethanol blending rate by 2025. And let me tell you why I put up this slide was to tell you that this time the whole effort roadmap targets are dot there, and it is happening on the ground. So real action is on the ground. In government first gave the interest subvention scheme, brought down an interest subvention to have more ethanol capacity build up. Environmental clearances were made faster. Standalone distilleries were allowed. So the government has done a tremendous job in building up the capacity. On demand side, the specification for 10%, 12%, 15%, and up to 100% blended oil are in place. Last year, 6 states have already reached 10% ethanol blending program, and going forward in few months, I'm quite hopeful that this 10% blending rate will be increased to 12%. A very strong push is happening for flexible cars, and as per the roadmap declared by the government, the flexi-fuel cars shall start rolling in the beginning of January 2024. The trials one will start in next 6 months' time, because I believe it takes around a year and a half to finish the trial runs. On supply side, government has fixed the minimum sale price of sugar. Government has also fixed a higher price for the sugar-rich material like bee molasses and sugarcane ethanol to divert more and more sugar to ethanol. Another recent development was that the sugar syrup storage technology has been piloted. There is experiment already done in one of the sugar mills in Maharashtra, where the technology and the enzymes have been developed so that we can store sugar syrup, make sugar syrup during the season, and then store it for the off-season distillation, which is a big, landmark thing. Commercial trials are going on. Let's see where it goes. If it becomes successful, there is a lot of scope to convert more sugar into ethanol within the existing capacity, because the capacity utilization will increase from, let's say, 200 days to 300 days. So these are the real effort which we are seeing on the ground on the ethanol side. Now, what shall it do? This is a broad analysis of the sugar balance sheet, which looks like, in 1920, our opening stock were 14 million tons of sugar, which by, 21, 22, and we see that will come down to 6.6 million tons, which is roughly 3 months of the consumption. Why is it happening in spite of higher production? That more or more sucrose for ethanol are getting diverted. The fourth line from the top, if you look at it, in 1920, 0.8 million ton of sugar was converted into ethanol. 2021, which is last year, just the year gone by, is 2.1 million. This year, we are expecting that 3.2 million ton of sugar will get diverted for ethanol. And next year, around 1 billion liter of new ethanol capacity is coming up. And next year, the diversion to ethanol shall be close to 4.5 million tons, and next year 5.2 billion. When I say 4.5 million ton of diversion to ethanol, it seems quite real, because the 1 billion liter capacity which we are talking about will come next year is already under construction. So these are the projects which are there and happening. So what it will do, if you look at the table below, Indian exports, which were roughly around 7.2 million ton last year, will taper off to 0.5 million ton, or India may not need to export at all in 23-24. And the Indian stocks of sugar will come to a quite reasonable level for 3 months consumption, which has been the norm in the past. This is the pictorial, dissemination of the information which I was sharing. The red portion is the production minus consumption in India. We had surplus of 2.1 million in 1920, 5.2 million in 2021. And if you look at 24-25, the production minus consumption, the whole S&D will get balanced as 0.4 million ton is almost nothing. Why it is happening? Again, as I explained, it's ethanol. From 2.1 million sugar used for ethanol, we are going to increase to 6.5 million in 24-25. And all the plants, capacities, and the regulation for that is happening in place and progressing. So what will it do for Indian sugar market? One is that the Indian sugar market, it will balance, because the supply of and demand of sugar will get balanced. And it will also give a roughly around 20% carbon-free energy for our consumers. And so one thing which is more apparent in India as compared to Brazil, where Brazil will be more dependent on the crude oil prices, but in India, the S&D, the individual S&D of India will get so better, so balanced, that probably in a balanced S&D, it will be a reasonable assumption or belief that the sugar prices will continue to hover around more than the cost of production because of the balanced S&D. So I am quite positive as far as Indian sugar sector is concerned and the Indian sugar prices are concerned going forward, primarily because of the ethanol play. To sum up, I will say that the world sugar balance sheet cannot afford loss of sugar production now in the coming years. And Indian sugar balance sheet will get balanced with largest growing ethanol program in the world. And the surplus from India will not be there. And if the world needs the sugar from India, world will have to pay the prices which is equal or more than the cost of production of India, and the global prices will have to stay at around 19.5 cents plus for India to export sugar. Thank you very much for being the patient listener.
Thank you, Mr. Ravi Gupta. And I think your presentation on the statistics for the next 2 years tells us why ISMA was sounding upbeat despite the WTO ruling earlier this week. We'll come to that during the questions, but I think we have a clear answer why the sugar sector or even sugarcane farmers need not be worried over the WTO ruling on the sugar exports or the subsidies that we are handing out. Now, I invite Mr. Kapil Dev, the Chief Business Officer, NCDEX, to make his presentation on the fundamentals of agriculture. Over to Mr. Kapil.
Thank you, Mr. Subramani, and thanks, Ravi. So, to provide such an interesting outlook for sugar. I am wondering that being an exchange, what should I speak on the outlook? Because the prices which are there on the exchange for today and for next 6 months are the better reflection of whatever outlook is being discussed. But still, I will cover a part on not on the fundamentals, but outlook and importance of outlook or importance of risk management we should have when we are talking about the outlook. So I have a small presentation to share. Is it visible, Mr. Subramani?
Yeah, it's visible.
Okay, thank you.
Perfect.
Thank you. Yeah. So being an exchange, my focus when everyone here is talking about outlook and the expected demand supply scenario and futuristic situation on the prices, I would like to speak, that how do we see these outlook and to connect with the price risk management. Because whenever we are talking about outlook and we are discussing a price point, a range, or maybe a target, it creates an expectation to every stakeholder in the ecosystem. And when that expectation is not, matched or not achieved, there are various questions which keeps on coming. There are various pain points which keeps on coming and which exposes us to various risks which impacts our business indirectly. We have seen that's happening multiple times. The recent example is oilseed, which I would like to mention that we started with a view that market is well supplied, consumptions remain okay, but we saw some things happening all of a sudden which led a super sharp price movement, impacted everyone in the stakeholder, and various concerns arising out of those kind of movements. What happens when this movement happens? Yes, we are worried about the profitability. We are worried about the sustainability. We look forward various policies changes. We go to the government, and of course, we make some noise in the ecosystem there, and we question the validity of the prices. So till the time outlook is not connected to the price risk management, I think the importance of outlook remains subdued. So I would like to cover that with one example. So why do we, talks about outlook? Yes, what is the supply in the international market? What is the demand of the commodities international and domestic market? What is the carryover stock? What is the raw material availability? What is the stock to use ratio? What is the risk associated with the commodity, whether it's weather, cost, macroeconomic condition, etc. But why, right? We use it for informed decision making. We use it for a price forecasting and cost of procurement and raw material. We talk about the fixing or cost margin on investing and trading profitability, and of course the better inventory management. So this is why we do the outlook. But can this entire only the outlook can provide all the solution? Maybe yes, because we have all the information which has been given by the best of the market. We have an idea how the prices are going to behave going forward after a month, 2 months, 3 months, 6 months, or maybe next financial year. But does this outlook help me to manage my uncertainties? Yeah, I know prices are going to go up, Now, what to do with that? Prices are going to be, subdued, or prices are going to be bearish. What to do with that, and how to manage, those outlook factors into my organizational operations. That is the point which is important, especially when we are going through situations last 1.5 years when prices are so unpredictable, and there are various factors which has really showed us that how a stable outlook can turn to a very bearish and very bullish market within a fortnight or maybe less than that. We have seen that's happening. You can see the post-COVID, how the trade in global indices is there. You can see the energy indices, how it behaved, a percentage change from the Feb 2020 level, which is just before the COVID started hitting the global market. And you can see how the things has changed in a short period of 1.5 years. And similar is visible whether it's grain or whether it's industrial metal index. So the volatility has remained super. But apart from this, what else has impacted, which we never thought and which was never discussed in the outlook, was of course the COVID-19. We never thought that Suez Canal blockage can impact the prices of freight and impact the prices of commodities, but we have seen that. We haven't seen that situation ever building up before. We have seen labor crisis happening in Argentina, prices of oil seeds were volatile, and we have seen global energy crisis, and we are talking about oversupply maybe in between. And if you see the volatility in the commodities in last year, which is the chart on the right side below, talks about how the volatility has moved significantly up in almost all the commodities. So from a normal volatility from 15 to 20% ranging, now we have reached even to 50% in certain commodities. Look at the soybean, look at the RMC, look at the spices and guar, and any commodity you name, even which are not there, the volatility have increased almost by 10 points, right, across the commodities. And what it brings when we talk about volatility have increased, it creates a risk, it creates an impact on the inventory management, and it brings again back, to what always exchange always speaks, that a risk management policy has to be in place whenever we are into the business of commodities, and especially these kind of situations. Just a case study. This is basis what has happened in the soybean. This was the outlook: surge in soya meal prices following consistent demand, positive price sentiments in other feed ingredients, lower than expected pace of soya meal imports to the country. In the international market, demands has improved. USD has reduced Argentina's soybean production. Soybean planting expectation in Argentina have decreased. Expert attributed the jump in soya meal futures. While in Indian market was talking about the good supply, which was almost in line to what has been projected since long. But if you see the prices, how it has moved on the right side, right? From a price level, from actually, if you go little back to the when the season started, from the April, it reached to as high as 11,000 or 11,000 rupees a quintal within a span of 6, 7, 8 months, right? Then something has happened. India market talk that India may allow import of GM soybean meal. It was allowed, and new season started hitting, and you can see the prices. So the fact is that market is uncertain. Outlook was there for the prices, but there are always certain news, certain events which has larger impact and which can disrupt the entire outlook projections we have and create a risk for an organization or in case anyone in the stakeholder. The first part, while it was good for the farmers, but bad for the processors and consumer, but second part of the chart is just opposite. So whatever price scenario happens, it goes up or it goes down, it impacts someone adversely, and that is something which need to be managed using derivatives market. So we know the uncertainties, how it impacts. There is impact, decrease in the price realization, impact of the next cropping cycle, decrease in the income of the farmer. So these outlook definitely has an impact on the farmers, how we are talking about that. If we are talking about high production, high supply scenario, high stock to use ratio, the carry is high, it will impact how farmers are going to behave going forward and how farmers are going to react on these outlooks. But the question is how to manage that situation if farmers are really finding it that prices will fall down. Then there are other segments, value chain participants, processors, of course, business strategy need to be changed, sales revenue need to be, will change, price transparency is always questionable when these kind of event happens. And we sometimes blame that market is not behaving the way it should have, basis what outlook was given 6 months back. The fact is market is behaving to certain facts which we never knew, but now those facts have a larger impact how the prices are doing. And of course, it reduces profitability of business, it brings uncertainties, it eliminates the viability of processing. We have seen crush margin going down in many industries. There is a higher competition because of thin margin, lower margin for the business, decrease in the purchasing power, disruption in the market, and of course, the question always comes on the transparency, the way price is being determined. So again, the outlook is important to understand the behavior of the market, but it's not sufficient to manage the risk associated with commodities. So again, we as an exchange says that risk management is something which should always be connected to the outlook whenever we are talking about. Why do we talk about risk management? We want to have a greater certainty around cash flows. We capture market share by offering a fixed price. We can do our pricing well. We know the input cost, or we know the risk which can arise from the input cost and how much we are managing using derivatives market. We want to ensure ourselves against any abrupt price movement and stable cash flow and better inventory management. So these are some benefits which this market offers. Just for an example, as I was discussing on the soybean, the prices started from the 4,000, reached to 11,000 within the month of 8. But we have people and we have case studies now, because this season has gone, that the people who had the risk management policies and they were hedging on the soybean, they were still buying soybean at 4,500 rupees, even less than that, when physical market was trading at 10,000. So while it offers this solution to the people who process soybean and to the consumer who are consuming soybean, whether it's soya meal or any other form, it also gives an opportunity to farmers, right, to lock a price and ensure the profitability without having a threat of prices going down. So now we have those tools. Mr. Sundaresan has spoken in the initial remark that the new tools are being introduced to this market. We have indices, we have options now. Farmers have started trading, FPOs have started trading put options, and they are locking the price at the time of sowing itself. I think that is something which we always need to talk, and we must talk whenever we are talking about market outlook. So this is just how we are doing it. Yes, there are various risk management traditional practices. We go into the forward contract, we try to change the prices of output, we do cost reduction, we try to change the product formulation, whether it's for cattle feed, whether it's for any other industry. But yes, I think if we manage raw material prices well in advance using derivatives market, many of the traditional approach can be well integrated with this approach. And we have forward, we have options contract, we have futures contract, depending on the need and the flexibility hedgers has. Various kind of strategies now can be explored even in the Indian derivatives market. I'll just like to give one small slide on how farmers are using. We have seen farmers now coming to the Indian derivatives market, hedging their crop at the time of arrival or maybe just before arrival. Now, thanks to SEBI, we have options allowed to be in the derivatives market, and FPOs are growing in the market. They are consolidating the farmer. They are having now that capability that they can open the account and they can trade. And with all the supports this ecosystem is getting now, we have FPOs buying put option at the time of sowing at the prevailing market price. And when finally they harvest, either they get the price which they have locked. If prices goes down, they get the difference. And if prices move up, they are free to go to market and get benefit of higher prices as well. So this win-win situation for the farmers is being created. And just opposite, it can be happen to the other market participants, whether it's processor or consumer, using the derivatives market in the similar way. So this market is now offering solution to various traditional challenges and the new challenges which we are now talking about on the farmer front. So this is my final submission that yes, outlook is important. We should be known to the fact that how market is going to behave, but this is not the only thing which will ensure the profitability. We need to have a risk management policy built around what outlook we do see and the external factor which can impact outlook and expected prices. I pause my presentation here. Thank you very much, and I'm open for any kind of questions here. Thank you.
Thank you, Mr. Kapil Dev, for your very interesting views that we have had. I knew that NCDEX did have some pressure this year because of soybean and mustard, even chana. We'll come to that later during our question and answer sessions. Now, I'll hand over the floor to Mr. Gnanashekhar Tyagarajan for its technical analysis on the agriculture commodities. Over to Mr. Gnanashekhar.
Good afternoon, Emaris. I hope you can hear me well.
Yeah, fine.
Good afternoon, friends. Happy to be here. Thanks for the opportunity, Emaris. I'm going to be talking about the technical analysis part of agri commodities and specifically cotton futures and edible oil futures. Of course, I could have covered much more, but since it has a very good relationship with international prices, it tends to sort of move well in the domestic markets also. So I picked out these two commodities to sort of highlight today. Now, technical analysis to most organizations dealing in physical commodities was quite new till some time back. In fact, MRS can vouch for that. We were, I think, one of the first to sort of start writing a column on technical analysis on palm oil and cotton futures way back, 15 years back or so. And I think it was quite well taken. From then on, I think most organizations who have price risk as far as commodities are concerned are very, very closely following charts, closely following technical analysis for understanding price direction going forward. So that's a great development so far. And I myself work with many of these organizations, both in India and overseas. And I'm seeing that more and more people are interested in technical analysis as a concept for forecasting prices. It's not that you'll be right all the time, but then price forecasting using technical analysis is something which is an integral part of doing business these days for most commodity trading companies. And one of the most important thing about technical analysis is that all the fundamental factors that the gentleman before me talked about, Mr. Ravi Gupta, are contained in one variable called the price. Whether it is bullish fundamentals or bearish fundamentals, all are finally into the price. And technical analysis deals with the price action alone. So that's where all this is stemming from. So if you watch the prices very closely, if you sort of work with prices very closely, which is what all the charters do, I think you will be with the price most of the time, and you can negotiate the turns and reversals that come up, and you'll be one up ahead of the market most of the times. So having said that, let me begin my presentation. I have a very small presentation here on both cotton and edible oil. Emaris, can you see the screen?
Yeah, visible.
Okay. Yeah. So basically, it all started in the beginning of 2021. I just want to refresh your memory back when the year began. The commodity index weightage is increased, and most of the agri commodity indices saw a sharp increase. And that this is the time when Fed was pumping in so much of money and stimulus that there is so much of money in the hands of funds to drive most of these markets. And it's exactly how it has turned out so far. Many of these commodities you see, which I've highlighted in red, the grains and soft commodities mostly, have skyrocketed. Most of them have made all-time highs, decade highs in some of the commodities. Basically, the index rebalancing is what sort of resulted in such a big move. Of course, the S&Ds were also important, but then the money that came, the stimulus money that came, that has ensured that agri-commodity prices reaching such high prices this year. Now it's interesting because we're getting into 2022 and the same indices will be rebalanced in the beginning of 2022, and it'll be very interesting to see how the rebalancing happened, because most of the funds that speculative funds that trade in the agri-commodity markets look at these index weightages and allocate money for the year. So it's very, very important. And my own sense is that next year, looking at the cycle, because agri-commodities always have a certain cycle. If they do very well this year, they might not in the next year, because farmers will have more incentives to increase crops in the subsequent year. Therefore, prices could be subdued. So I think the index rebalancing could come out on the lower end, but we need to wait and watch till the beginning of January. So the present scenario, I'm going to be dealing with cotton to start with. So cotton right now, after making a decade high, is sort of moving in thin volumes, and it's caught in a range at this point in time. There are a lot of fundamental developments. I've tried to cover some of it in this presentation. But what we need to know is, it really peaked sometime back. The international prices saw almost a 11-year high being made. It sort of broke out of these 10-year highs with exceedingly sharp volumes. Again, thanks to the speculative activity, as well as many of the fundamentals that fell into place. So cotton futures really took off. Now, what is happening currently is that, again, thanks to all these funds, you can see that the commercials and non-commercials, this is the best part about international agri-commodities. On a weekly basis, you get this report called COT, which is the Commitment of Traders report. And I hope, I will live to see such a report in the domestic markets too. Because in the overseas market, if one were to do a trade, an agri-commodity trade, then it has to be disclosed as to whether it was against a commercial transaction or a speculative transaction. So the CFTC comes out with this beautiful report saying how much of commercials are long or short, how much of non-commercials, which is basically speculative funds, long or short, and the non-reportables are the smaller, minor, investors and traders. So the report kind of beautifully summarizes, where markets are positioned at any point in time. So cotton is like that. You have commercials who've been largely caught on the short side. That's the reason why you see this red highlight of this arrow. And non-commercials, which are speculative funds, who've been largely on the long side, the major green portion. So the view is still at this point in time, as far as cotton is concerned, is quite bullish. And commercials, the industry is on the short side at this point in time, and we're seeing that slowly changing as we go forward. But that's the present scenario. There's another interesting fact as far as cotton is concerned, which is the unfixed call sales. Many of these mills that sort of routinely buy cotton, they use this instrument called on-call. So this on-call contracts shot up to a great extent for the December contract. And many of these mills were forced to price these contracts in ice, and they couldn't wait when prices started going up. So it led to some kind of a chock-a-block, and many of them buying at high prices or fixing at high prices. So that was one reason why we saw this unprecedented rally. And I think the markets kind of knew how the on-call position was, because again, CFTC comes up with this report once in 10-15 days as to which month the call position is much higher. When I say call, I'm not talking about options. but this is a product called on-call sales done by textile mills. If you can see in the month of December, it peaked. I think the number of on-call contracts peaked, and now it is all moved to March. So presently, I think the current situation is that the on-call position is very, very high in the month of March, which only means that the market is expecting prices to come down in the month of March. Textile mills just have taken a view that by March prices could start coming down because of the arrivals, because of various other factors. But this is one important data one has to take into account. And of course, the Cotton Association of India reduced the final cotton crop size in India. That also added to the overall bullish sentiment. And the USDA also, increased the cotton demand scenario, which kept. I think most of the exports started picking up in a big way post-COVID, and so many other positive developments that happened, and then tightness in supplies. So basically, the fundamental side was extremely, extremely supportive of prices to break and go higher towards 10-year highs. And the arrivals we're seeing are quite normal. In fact, slightly below normal. That's what we're hearing. So where are we headed now as far as cotton is concerned? Now you look at the ICE markets, which is the benchmark for cotton globally. It tested around $1.20 just a while back, and it's now consolidating. It's sort of taking a breather at this point in time. But with the economic recovery that we're seeing, and the demand that we're seeing post COVID, the kind of online business that is picking up for garments, there is a tremendous scope for prices to rise. And in fact, crude oil prices also impact cotton prices in a big way, because the polyester prices are determined by how crude oil prices move. So if crude continues to rise the way it is rising, there is a good chance markets will move to natural fibers, and that will drive cotton prices even higher. So with that sort of a background, if you look at the technical picture, I'm still convinced that there is more upside in the coming quarters, and this $1 per cent, per pound is something which is going to be very stable, and we would see much higher prices going forward. That's basically the technical view that's coming for cotton. This is something which I had predicted sometime back. I'm talking about at least 4 to 5 months back. The technical pattern indicated this is a inverse head and shoulder pattern in cotton. So this is a pattern which we normally look at when prices start behaving in a bullish manner. And the target, this inverse head and shoulder pattern, technically was indicating around 1.4 cents. So we are somewhere around 110 right now. So we have some way to go. And technically, I think that's the target for 2022 as far as cotton is concerned. In the domestic markets, as for cotton, we have made a new high here also in India, and 34,000 was the recent high. But we have corrected to 30,000 levels. I think we are now headed somewhere closer to 34, 35, or even slightly higher beyond that. And eventually, my feeling is that the second half of 2022, prices could come down below 30,000, somewhere close to 28,000, and settle down. Because again, the cycles will start working. Farmers will have more incentive to produce more cotton going forward. So with that, I'll move to, and of course, let's not forget March 2011. That's when cotton hit a new high of $2.10. And such exaggerated moves we have seen have always resulted in sharp retracements, and that's what the industry has to watch out for. And it's better to plan hedging strategies as prices rise, because then the mills and all the buyers will be left with high-priced inventory. So hedging strategies are going to be the key thing, and hedging is an integral part of most businesses. And if one takes to hedging, I think the cash flows can be managed well, the profitability can be managed well, competitiveness will increase. And my friend from NCDEX just now mentioned how all these things are very important for price risk management. So that's where cotton prices are right now. So I'm moving to palm oil markets, the edible oil markets. Palm made a new high in 2021, basically because of tight supplies and extremely robust demand post COVID-19. And because of that, we've seen such unprecedented rise in prices in edible oils. And that has affected the overall spectrum of consumers who consume edible oil in India. And palm being the cheapest oil generally, is probably in parity with most of it tends to be at a discount with many of the other peers like soy oil and other sunflower oil. But now it's at parity or sometimes even at a slight premium. And the surprising part is that we are in the winter time where generally palm is not preferred, but still the prices are somewhere near the all-time highs. Of course, it has corrected recently, but still the fundamentals are extremely intact. That's basically what I want to point it out. This is the recent MPOB data, which also sort of confirms that. Now, high prices are supposed to result in lower demand, but that's exactly what we're not seeing in many of the commodities. These conventional demand supply factors are simply not at play at this point in time. I think one of the main reasons is the stimulus. I think there's a lot of money chasing commodities, so it doesn't matter what kind of fundamentals are, as long as funds are able to make money. But that might come to an end with Fed starting to increase rates going forward. So we might not see that kind of speculative activity which we saw in the previous year and years. So it could be much more balanced. I think the market will slowly start falling into the supply-demand dynamics in 2022. That's my personal expectation. And like I told you, palm oil prices made all-time highs. 5,250 ringgits is basically where it hit, and our own sort of price forecast for palm is that it would come down somewhere close to 4,000 ringgits, find a lot of support there. And as I said, the fundamentals are still extremely strong. There's still a lot of tight supply situation there. And then post-COVID, demand is very strong. Chinese New Year demand is going to be very strong. So a lot of these factors are, in play as far as edible oil markets are concerned. And we think, new highs are a norm for 2022 also. So we're looking at 5,500 ringgits at least in the coming year. And in the domestic markets, palm and MCX is ruling around 1,050 thereabouts. But I think it should stabilize around 1,000 and then start moving back towards 1,250, 1,300 levels, where it might peak out in 2022. And from there, prices could see a drop. But right now, I think we're in that phase of consolidation, and we expect prices to go up. So with that, I'll end the presentation. God bless. Thank you and stay safe. Over to you, Maris.
Thank you, Nyana. We still remember how your technical analysis on palm oil and cotton were followed very vividly on BusinessLine. We had this done. So now it's time for the questions and the answer session. I would now post this question to Mr. Ravi Gupta. Now, a few days ago, there was a seminar, global seminar, which said that Indian sugar is required to meet the growing demand, global demand for sugar. At least 2 million tons India needs to meet that demand. At least that's what they say, to meet the rising demand. And we are saying that the next couple of years, India's exports might drop. Now, won't this lead to a rise in sugar prices because of India not exporting, and then there is a demand, and then there's a So will that not lead to a rise in the sugar price? That's what I want to pose to Mr. Ravi Gupta.
Yeah, thanks. So yes, I think the more or less what you heard in that seminar is I have the similar view that going forward in terms of global balance sheet, the balance sheet will get tighter and tighter only because there will be a gap in the production and consumption. So there will be a deficit which will be going henceforth. And the global market will require Indian sugar. And that's precisely one of the reasons is that the global markets are trading at a level where Indian exports are viable. So it clearly indicates that the Indian sugar will continue to get exported and the world market needs it.
Okay, thank you, sir. Now I would pose this question to Mr. Kapil Dev. Mr. Kapil Dev, we saw soybean prices rising both in the physical as well as futures market, and there was tremendous pressure on NCDEX, or at least there were allegations made against NCDEX. Now, how did NCDEX handle this situation, and going forward, how do you think will this price for the futures pan out? I mean, if you can say that, otherwise you can just tell sort of problems that you faced last year because of the rise in commodity prices, especially chana, which is now facing problems, and then we had with soybean and mustard oil.
Yeah, it's right. Being in exchange, multiple time it comes to us that prices trading are not in line to what we thought. And as I mentioned, that's the problem statement, which most of the time we do face, that market start reacting when prices moves beyond their expectation. And I think that's the time, that's the point we want to again iterate that, the hedging and risk management, market is volatile, you never know. While we are talking about oil prices moving up, the prices of oil seed, especially refined soy oil at seaboard, moved up by 151%, while in our case, it was only 71%, while we are importing most of our soy refined, right? So the questioning on the price is the easiest way to get exit and not, talking about the risk management, right? These markets are meant for risk management. These give you the indication that what is going to happen in the market, yeah, what is happening at this point of time. We do not have sugar future, doesn't mean people are not hedging. They are hedging at ice, right? And Mr. Ravi is here. He can definitely put better light on this, right? We know that these are the markets are meant to handle these kind of crises. We have now fundamental, we have best of the best technical thing. We need to have the risk management in place. As it was mentioned, COT, right? Commitment of Trader report. Yes, we are not up to that, but we have started providing those kind of information on the daily basis, not even the weekly, that what kind of categories are holding the open interest, what kind of, how much open interest is held by top 10 participant, what is FPO participation, what is hedger participation, what is group participation. So those information are being made available to the market. The stock is available on the daily basis. Our focus is that, right? Even in the seaboard market, if we talk about soybean contract, right? And you go to the COT report, which we just discussed, there are only 200 and 300 people who carries 80% of the open interest on the larger, on the longer side, right? It means hedgers drive this market and they make it a liquid, right? And we are talking about a contract which carry open interest of more than 100 million ton kind of open interest, so maybe 300 million ton, right? We need to start utilizing this market efficiently. The economic rationale of having the derivative market is, to protect yourself from the risk management, and then rest of the things come secondary. Unlike capital market where we go and we trade for a capital gain. Till the time, all the industry come forward, start using this market. When we are talking about the prices, advisory on the risk management has to be compulsory, which usually we do not see. We talk about a lot of volatility. We are still talking about volatility. Prices may go up, demand may go down. But risk management policy is something which is not connected to this discussion, which should happen. So that's what we as an exchange keep on focusing with the value chain participants, with the farmers, with any other market segment. And through this platform also, I want to say that these market are the platform which provide you an opportunity to manage all kind of risk. Do come forward, start using it. Globally, it has been accepted. Global markets are trading what's happening at seaboard and Bursa Malaysia or ICE. We have futures contract which are built in last 18 years in the Indian market, and they definitely, and they must come forward and start using it for the reason they are built for.
Thank you, Mr. Philip. I would want to pose this question to Jnana. Jnana, in November, what we have seen is soybean oil imports of soybean oil catching up with palm oil imports in India. In fact, they were higher. Now, have you had a look at the soybean oil prices, and have you seen how it will move? Now you're saying that palm oil has more head. Any idea how soybean oil could move, and what sort of prices can consumers in India expect?
Like I mentioned before, Amaris, that the price differential between palm and other oils, and especially soy oil, it plays a huge role in consumers moving from one oil to another. And during the time you're talking about, November or even now, this is a time when palm is generally not preferred because it tends to condense during winter. And there's a lot of emphasis on soy oil, and market gets more interested in soy oil. So that's the reason why we saw that kind of a huge jump. But it was not anything to do with prices. Price-wise, I think palm still is taking the lead at this point in time. Generally, it is soy oil which gives the lead for the market. But this time around, palm is taking the lead simply because the fundamentals are so tight there. The labor situation, the supply, post-COVID, all that is resulting in tight supplies. Whereas in the soya markets, it's a little different. I think the fundamentals are slightly favorable and better, and we're seeing more arrivals, more crop. In fact, the next year, because of the way soy prices have behaved this year, it looks like it could be a record crop in the coming season.
Projections are for a record crop in Brazil.
That's right. So cyclically, I think soya might not perform as much as palm, but the tightness in palm and is something which is going to stay for some more time, at least for a quarter, because we're getting into a low production season in palm in the coming quarter. So I think the soya oil prices compared to palm are going to lag behind, and palm is going to take a lead. But at the same time, soy prices will be sort of on the uptrend. The bias will be positive, but the upside will be limited.
Thank you, Jnana. Now I would pose this question to Mr. Ravi Gupta. This is from one of my colleagues, Prabhudatta Mishra. Now he's wanting to know whether there is a possibility of India following Brazil model by diverting surplus sugarcane directly to ethanol to keep sugar prices bullish through a controlled sugar production mechanism.
Yes, I mean, that's precisely what India is doing. That's what I presented in my slides as well. You see, the India surplus today, if you look at it, is around 6 to 7 million tons, right? And that is which we are converting to ethanol, right, to balance the S&D. So going forward, I think India is definitely following the same path which Brazil has followed, that you produce surplus sugar into ethanol and have two products rather than one single product as sugar. You have sugar as well as ethanol, and keep that flexibility of production maintained. So I agree with the person who has proposed this question, that India is following Brazil model, and that's what it will do going forward as well.
Thank you. Now, Mr. Kapil Dev, I would want to remind you what happened in 2008 when I think NCDEX chief, Mr. Ravi Kumar, was the first to write to the government that wheat prices in the futures market was seeing a rise and India could face some problems on the supply. And now what we saw later was that the government banned wheat futures, and then when the prices of pulses all increased, there was a ban. Now, given the situation where now we have a problem with the S&D with regard to pulses and other things, do you think it will be prudent for India, for the government to initiate the futures on the pulses also? Because since you have brought in options and other things, that could also help farmers.
Correct. That was interesting time. Tight supply situation for wheat and various steps were taken by the government. But the interesting thing, which I need to mention, that Indian government, or some agency on behalf of Indian government participated in global wheat futures, and they bought some option. They did some options trading, right, to safeguard themselves on the continuous price rising. So the utility was, that time was there and it was utilized. Post that, Hafed has started trading wheat futures, and there is a Harvard case study that how a government agencies can use this market for a better realization of the farmer. We have seen on and off multiple bans, recently also two, and whatever studies have been made by various committee and recommendations, that futures have nothing to do, to the price rise. Actually, they tell you what is going to happen, right? Market is a forward-looking factor, especially derivatives market, and you need to act basis what signal market is giving at the appropriate time. So we are always, in line to what you have just said, that farm now with options and futures both are active. Farmers can use derivatives market, they can buy put option. Some support to the farmers can be given. We have run that pilot program where we have subsidized options premium for some FPOs where they log prices of chana and mustard at the time of sowing itself. And we have various examples where hedgers has managed extreme volatile situation using derivative market. We all need to come forward to make this market more liquid and get the best out of it. So we definitely keep on saying the same thing. And again, I will say the same thing, that we need to have more and more features. We need to be the global benchmark for various commodities wherever we have the opportunity. And even in global market, right? We are the largest now. We are having an important role to play in the global sugar market, right? We are importing, exporting a lot of sugar, a lot of paddy. We do not have any low domestic benchmark price, at least at this point of time, because of the various intervention we have seen. So I think it's the time to relook to all the policies towards the derivative market, and the focus should be to grow the local benchmark prices. That definitely give you a advantage in the global trading as well.
March in 2017.
Yeah, Janji.
Emaris, I just want to add to that. Basically, what we have seen in agri-commodities lately is that the physical prices are generally what gives direction for futures. But it's the reverse now. The future prices, which is dictating direction for physical markets. So it's the tail wagging the dog and not the dog wagging the tail. So with that, I'll just hand it over back to you.
Yeah, but Jana, coming back to you.
Yeah,
now,
I differ on this point.
Earlier this year, we had. Yeah, go ahead.
Yeah, I differ on this point. Means like the most volatile commodities we have seen in recent past. Right? The spot is something which drives the derivatives market. And the uniqueness of Indian derivative market is that it gets settled on the spot, whatever it is, right? And that's the unique mechanism which Indian market follows, which is nowhere in the world. Future settles on futures and delivery happens post delivery, post expiry. We have future settling on the spot of a particular market. So whatever anomaly, it may be there. As I said, future is for after 2 months, spot is for today. So there has to be some difference. Sometimes it may be positive, sometimes it may be negative. But the fact is that end of the day, it's a spot where all the position gets settled. So yes, I think these are the points which are point of concern, but we have to see it differently and with a different perspective. Thank you.
Thank you. Nana, getting back to you now. Earlier this year, there were fears of crude topping $100 a barrel. Now, in that situation, both the edible oils could be, there could be diversion for biodiesel or palm oil, or so the other oils there could be diversion, and even in the cotton, synthetic would have gone up. How do you see in case crude oil goes high next year, it scales up, say because of the geopolitical situation? How do you see cotton heading up or down?
See, first of all, as far as the biodiesel factor is concerned, I think US has made it very clear that the edible oil refiners there won't get that kind of advantage which they were expecting. So clearly that part has been negated. But as far as cotton is concerned, you're right. I think with the way crude prices are headed, polyester prices and the byproducts and all that is going to increase. Cost of that will increase. And that would push most of the traders back to natural fibers, which is cotton. So that to me is a very, very positive factor. And my own take on crude is that yes, we headed back to $85 or thereabouts. In the coming years or in 2022 with Fed increasing interest rate, you might not see the kind of speculative activity that we saw in 2021. Both ends will be caught in a tight range, and the lower side around 60s and the higher side around 80s. And I think my personal take is that it won't cross $85, $90. And because of that, edible oil prices will also remain soft in 2022.
And now I have this question for Mr. Ravi Gupta. It's from Mr. Somnath Nag. He wants to know whether electric vehicle, the rise in the use of electric vehicles, will that dent the demand for sugar or ethanol, sorry?
You see, my answer to that we are so low in renewable energy consumption that there shall be a space for everyone. There will be space for electric vehicle, there will be space for ethanol, there will be space for 2G ethanol. So we are today, it's what? We are just not even 7-8% of renewables in our energy consumption, which itself is going by 10% year on year. So I won't say that electric vehicle will not happen. It will happen, but in spite of that happening, everybody will have a pie to eat. So it will be coexisting rather than one not existing and the other one existing. That will not happen. And why I'm more favorable for ethanol? You see, ethanol is kind of a low-hanging fruits because all our vehicles are running on liquid fuels. So we can run the same equipment immediately by just putting ethanol, whereas electric vehicles needs to evolve. I mean, new equipment, people have to change vehicles to get into the electric vehicles. So it will have its evolution, and it will have its own also it will have the space in the renewable energy, and everyone will coexist. So I don't see a threat of electric vehicle on the ethanol program at all.
Thank you, sir. Now this question is for Mr. Gnanashekar. This is from Santosh K. He wants to know, with the government introducing PLI for textile industries, will we see demand for cotton going down in India? And will there be more shift to man-made fabrics?
Absolutely. I think, that's the trend that we're expecting going forward. People might disagree on that, but my own personal take is that, as the energy prices continue to rise, as the transportation prices continue to rise, and we have a huge amount of logistical issues which are, pushing most commodity prices up. That's one thing which I sort of forgot to highlight. Clearly, cotton prices are looking quite good going forward, except for the fact that it's done so well in this year, and that will incentivize farmers to plant more in the coming season. Barring that, and barring any weather developments, I think the PLI factor clearly is helpful for cotton prices going forward. And please understand that cotton prices are coming out of a big lull. It's almost in the last 10 years, it's been in a very, very stable range. It's just moved out only in the last 2 months. And with the fundamentals that we're expecting, and with the support from energy markets, I think there's a very, very good possibility we would see high cotton prices in 2022 also.
Well, thank you, Jana. So this is again addressed to Mr. Ravi Gupta. This is from my colleague Prabhu Datta. He wants to know whether grain to ethanol is being allowed, and there is a demand to shift from water guzzling crops. Now, what does that portend for sugarcane in the future?
I need to have a separate session with Mr. Prabhudatta, I guess.
Fine.
No, but yeah, to answer his question, the plan of the government to reach 20% ethanol blending is that the requirement of ethanol will be something around 10 billion liters. Out of that, 5 billion liters will come from sugarcane source, and another 5 billion liter will come from grains. So to achieve even that 20% ethanol blending rate, both grain ethanol as well as the sugarcane ethanol will be required. And that is the plan which is given in the roadmap of the government. And that's what which this government is doing. So both will coexist.
Thank you very much. And there's one particular question that's coming from Dr. M. Jayakumar. He's raised about sugarcane dues to farmers. Now, I would want to tell him and also to tell the people who are here that earlier this week, the government told Parliament that 98% of the sugarcane dues to farmers has been cleared. Would you want to say what's happening on the sugarcane arrears front?
So you see, I mean, roughly, I'm just talking out of my memory. There is around 92,000 or 93,000 crores of sugarcane dues which were there. And out of that, only 4,000 crores of dues are unpaid to the farmers. So I would rate it as if 100% has been paid, because this 4,000 crore also the dues are from the people who are kind of in chronic kind of financial distress, and few of them. But barring this 2-3% of dues which are pending, rest everything is paid and paid quite on time. So in fact, all the actions of this government, has led to a situation that there is hardly any farmer dues which are pending, which used to happen. And I think one major step towards achieving this goal is the ethanol program.
And my final question is addressed to Mr. Kapil Dev. What do we expect from NCDEX for the new year?
A calendar.
That's a good one, but
we
are not asking,
Mr. Ravi.
We are asking for the investors or
yes. No, we look forward, coming up with new product. Some interesting developments are happening, as I told you. Getting farmers to the Indian derivatives market was never thought of when it was started. Now we are having 1 million farmers indirectly trading through some FPOs. So that efforts will continue. We look forward to get few of the contracts back, which we have lost over a period of time. And of course, another thing which we are looking out, the pushing some infrastructure push through ENWR, where a lot of transparency can be built to the ecosystem. We don't know, how much is the stock. We don't know how much is the consumption. We don't know the visibility of the material we are holding. Now we have a tool, which is ENWR. We are pushing a lot to that, because the more the transparency in the spot market, less the questions people will have on the futures market. So that is something which we need to do at this point of time.
So thank you all. We can go on, but time is a limit right now. It was a very wonderful session here, and I thank all of you for your very insightful answers. I mean, they were really very helpful for us, and we have to unfortunately wrap it over here. We have already run out of time. We wish you all a good time for the rest of the day, and hope to see you all tomorrow for our second day, where we have the sessions on first on precious metal at 11 a.m. and then followed by the session on basic base metals. See you all tomorrow.
Thank you. Wish you all a very happy new year.
Thank you. Thank you, everyone.